My name is CPA Catherine Asemeit, the Director, Standards and Technical Services at IFRS and your main liaison to the standard setting boards. IFRS 18 was issued in April 2024 and will apply to annual reporting periods beginning on or after January 1st, 2027. This standard encompasses requirements for the presentation and disclosure of information in financial statements for all entities applying IFRS. So let's take a brief look at the history of IFRS 18. The project was initially discussed by the board in April 2016, and by May 2019, a decision was made to move forward with an exposure draft rather than a discussion paper. This led to the publication of ED 2019/7 in December 2019, with comments requested by June 2020. And after extending the comment period, the final IFRS 18 was issued on April 9th, 2024. So the primary objective of IFRS 18 is to set requirements for the presentation and disclosure of information in general purpose financial statements. This ensures that financial statements provide relevant information that faithfully represent an entity's assets, liabilities, equity, income, and expenses. IFRS 18 applies to all financial statements prepared in accordance with IFRS. It's important to note that while IFRS 18 covers presentation and disclosure, the recognition, measurement, and disclosure of specific transactions are addressed in other standards and interpretations. IFRS 18 introduces several key definitions such as aggregation, classification, disaggregation, and general purpose financial reports. Maybe I could just go briefly into each of these. Aggregation means adding together items that share characteristics that are classified similarly. As well, classification means sorting items based on shared characteristics, while disaggregation is basically separating items into components with distinct characteristics. In other words, general purpose financial reports specifically mean reports which provide information that is useful to primary users in making resource-related decisions. So these definitions help ensure clarity and consistency in financial reporting. The objective of financial statements under IFRS 18 is to provide valuable financial information about a reporting entity's assets, liabilities, equity, income, and expenses. A complete set of financial statements includes a statement of financial performance, a statement of financial position, a statement of changes in equity, a statement of cash flows, notes to the financial statements, and comparative information. Each of these components must be presented with equal prominence. IFRS 18 assigns distinct and complementary roles to primary financial statements and notes. The primary financial statements provide structured summaries of an entity's financial status, aiding in comparison across entities and periods. The notes, on the other hand, supplement these statements with additional information necessary for complete understanding. And as I had mentioned earlier, IFRS 18 emphasizes that information should not be omitted or obscured if it could influence users' decisions. Entities must present additional line items and subtotals if necessary to provide a useful structured summary. Clear identification of financial statements and prominent display of essential information, such as the reporting entity's name and reporting period, are required. Aggregation and disaggregations is very crucial under IFRS 18. Items should be aggregated based on shared characteristics and disaggregated based on distinct characteristics. This ensures that material information is not obscured, therefore allowing users to better understand the financial statements. The statements of profit or loss must include all items of income and expense classified into operating, investing, financing, income taxes, and discontinued operating categories. This classification provides clarity on the sources of income and expenses, aiding in better financial analysis. And therefore, the statement of financial position should also classify assets and liabilities as current, or non-current unless a liquidity-based presentation is more useful. This helps users understand the entity's financial stability and the liquidity position of the company. So in conclusion, ladies and gentlemen, IFRS 18 enhances the presentation and disclosure of financial information, making financial statements more useful and transparent for users. As we approach the effective date of January 1st, 2027, it is crucial for entities to familiarize themselves with these new requirements. Thank you for joining me today, and for more information, please visit the ISPAC website, the IFRS Foundation and ISB websites. Stay tuned for more updates and insights on IFRS standards and all other technical information.